Hey everyone, John Chow here from johnchow.com, and welcome to another episode of Driving with John Chow. I've been promising to do a series on investing and how I invest my money and what I put it, that kind of stuff. People have been asking me that. So I figure I'll do a little series on it. But before I actually get into what I buy, how I buy, my methodology for buying it, I want to talk about just some general overview of investment and risks. And we'll start with risk. Like what risk? Risk is a four-letter word, so we'll start with the four-letter words. A lot of people won't get into investment or won't even start an internet business or won't do a lot of stuff because they think it is risky. And when and one of the most common misconceptions I hear is people think that, of all the investment category, because most of my investment is tied up actually in investing in stocks and companies. And I do have real estate investment, but it's not as big. And so when I tell people that, a lot of people automatically assume they think that real estate is safer and stock is risky. Now, I don't know where they actually came up with this idea, but I hear it seems to be common. People think real estate is safe, stock is risky. When the truth of the matter is, real estate is riskier, significantly riskier than trading in stocks. And I believe a lot of this misconception happens because people do not know what risk is or what entails risk. From an investment standpoint, looking at it strictly from an investment standpoint, one of the biggest factors of risk is liquidity. In other words, when it comes to your money, how fast can you turn that asset into cash? The faster you can turn that asset into cash, the more liquid it is, the less risky it is. All right. So that is one of the biggest factors when it comes to risk. There's nothing, of course, there's other factors, but one of the biggest factors is how fast can you turn it to cash. Right? And when you look at it from that point of view, real estate is by its very nature not a very liquid investment. If you need to sell, if you need cash, you need cash for something, whatever it is, you need cash for something, you got to turn one of your assets into cash, and you have this house sitting there. How fast can you dump it? How fast can you turn it to cash? Generally, selling a house takes months, sometimes years, depending on how expensive it is. And if you really need to get rid of it fast, you either have to drop the price significantly, in which case you may not make a return on your investment, or you sit and wait. Contrast this to the stock market. If I want to turn any of my asset into cash, I just fire up my TD Waterhouse, log in, and hit sell, and a few seconds later, it's sold, just like that. So, liquidity is one of the biggest factors of risk, and so just on that alone, the stock market is actually less riskier than real estate. And there's this chart. I'll see if I can find it, and if I do find it, I'll put it up on the screen. It shows the risk potential reward chart. And if you look at this is from safe investment to the riskiest investment. The safest investment is usually generally a government T-bill, because it's guaranteed by the government, and you're always going to get your money back. But because it's the safest investment, the lowest risk, it has the least interest or least return on your money. On the other spectrum, the highest investment is the commodities futures trading. That is extremely risky because of the leverage involved. The leverage involved is crazy. Like if I want to buy $1 million of T-bills, I only have to put up like $10,000. So that's like a 1,000 to 1 leverage ratio. I mean, real estate, you can leverage about maybe 5%. You put down at the highest, you put down 5%. You control the house, so that's only 5%. That's another factor of risk. How much leverage can you apply? When I buy a stock, I generally just buy with cash. I mean, I could borrow money to buy stock on a margin account. That's 50%. So I put up half the money. My broker puts up the other half of the money, and that's a 50% leverage ratio. Whereas buying a house, you can, if you're buying, generally, if you're buying it for investment, you need to put down like 20, 25%. So if you're buying it as a personal residence, you could put down low as 5%. So that's great leverage. Like, like to buy $100,000 house, you only got to put down $5,000, but you're controlling a $100,000 asset. So, if the house goes up by just 5%, you double your money. But if it goes down by 5%, you just lost your initial investment, right? So because of the leverage, the higher leverage involved, and the fact that you cannot turn your asset into cash really, really fast, the illiquidity and the higher leverage, real estate is a more risky investment than the stock market. So yeah, that's what I want to talk about for this episode about risk. Next episode, I'll talk about other factors affecting investment, and then I'll actually talk about what you should actually buy. All right. So have any question, leave it down below. I'll get to them. In the meantime, give me a thumbs up for this episode. Like and share my video. Subscribe to my channel, and I'll see you guys on the next episode.